Hi, small investor here. Today we're turning the spotlight on Target, one of the biggest names in American retail. We'll uncover the numbers, the growth story, and what investors like you and me need to know. Let's get started. Target operates solely in the United States, with 1,978 locations across 51 states and 1,305 cities. Currently, it ranks as the 7th largest retailer in the US by revenue, generating almost $106 billion in 2023. Looking at the stock price, Target has shown consistent growth since 1994, with a few notable bumps along the way, like in 2000, 2009 and 2017. Then the stock price surged and reached an all-time high of $266.39 on November 16, 2021, marking the end of around 500% stock price run in 4 years. Let's talk about Target's plan for the future. Over the next decade, Target aims to open 300 new stores, averaging 30 new locations each year. To put this into perspective, the company opened 29 stores in 2020 and 2021, the most in any single year. Historically, from 2009 to 2024, Target opened an average of 50 stores per year. Here, we didn't count any stores opened and later closed in failed Canada endeavors. In addition to new store openings, Target plans to enhance the majority of its existing locations. These upgrades include full-scale remodels, adding Ulta Beauty locations, upgrading store fixtures, and supporting same-day services. The collaboration with Ulta Beauty is a key part of Target's strategy to attract a broader customer base, offering premium brands and elevating the overall shopping experience. In February 2024, Target launched a new low-price brand called Delworthy. This brand features nearly 400 everyday essentials, with prices starting at under $1 and most items priced below $10. Categories include apparel, beauty, electronics, home goods, and more, making it easier than ever for customers to find affordable basics. Target has also revitalized its Up & Up brand, focusing on improved product quality and a broader assortment. Looking ahead to early 2025, Up & Up will introduce new products such as pain relief medications, napkins, protein powders, batteries, and computer accessories. Additionally, Target is making strides into the wholesale market. Its private label children's brand, Cat & Jack, will soon be available through other retailers. This marks Target's first journey into wholesale, expanding the brand's reach and accessibility to new customers. Now let's talk about financial performance. Like many retailers, Target is heavily focused on expanding its digital e-commerce presence. In recent 3 years, around 18% of the company's revenue comes from e-commerce, while the remaining 82% is generated through its physical stores. When you look at Target's merchandise categories, the company lists 5 areas: apparel and accessories, food and beverages, home furnishing and decor, beauty and household essentials, and hardlines. Among these, the biggest contributor to revenue is the beauty and household essentials, which saw its share jump from 26 to 30%. The second largest category is food and beverages, which also grew from 20 to 23% over the 3 years. In contrast, the other 3 categories experienced a slight decline in their revenue contribution relative to the growth of the first 2. This shift may be tied to Target's incorporation of Ulta Beauty locations within its stores, a move that is likely to further boost the beauty segment's share in the future. As this partnership grows, we could see an even higher percentage of revenue coming from beauty and household essentials. Another key highlight from Target's annual report is that approximately 1/3 of its sales come from its own private label and exclusive brands. These brands play a significant role in driving customer loyalty and differentiating Target from its competitors. They also provide higher margins. Now let's take a closer look at the revenue numbers. Target fiscal year ends in January, which is why the reporting year is referenced this way. For example, the $107 billion in revenue was achieved between January of 2023 and January of 2024. With this out of the way, let's jump in. Target has experienced in 2014, 2017, and 2024 a decline of revenue compared to the prior year. If we examine the compounded annual growth rate from 2009 to 2024, it comes in at 3.4%. However, if we shorten the period from 2009 to 2020, the CAGR drops to 1.7%, because we exclude the high jump caused by the pandemic. Target is also experiencing gross margin decline. We can see that the past 2 years were the worst, and those numbers, colored in light yellow, are below the average derived from 2010 to 2024, and with the exception of 2016, all occurred not so long ago. When we turn to net income, Target has maintained an average net profit margin of 3.6%. The highest margin was recorded in 2022 at 6.6%, while the lowest margin, if we exclude the loss from the last quarter of 2014 because of Canadian market exit, was 2.5%, reported in 2023, just 1 year after reporting the best profit margin in the last 15 years. Another important metric to consider is revenue per store. Over the years, this figure has generally trended upward. On average, Target generated around 43 million per store. The lowest revenue per store was recorded in 2009, just after the financial crisis, at 37.3 million. The highest revenue per store came in at 2023 with 55.8 million. Notably, we've seen a significant increase in revenue per store starting from pandemic onward. If we take the average from 2021 to 2024, then we came in at 53.4 million per store. Now let's simply apply these numbers to project a revenue range, from what we believe would be the bare minimum to the maximum that Target could achieve. We are basing our revenue projections on the numbers of stores. For 2025, we are using the store count of 1,963, which was the most recent figure reported in the last full year report. For 2026, we are using the store count of 1,978, which was the number reported in November of 2024. Moving forward, we will assume that Target will open 30 new stores each year as part of their plan for growth over the next decade. Starting with minimum scenario, using 37.3 million per store, the total revenue would come to around 73 billion. However, this number Target already achieved in the first 3 quarters alone, where it posted a revenue of 75.7 billion. In a more realistic scenario, where the average revenue per store is 43 million, that would bring the total to around 84.3 billion, while an average over the last 4 years of 43.4 million per store would bring Target's revenue to 104.8, with our last, the highest revenue, peaking at approximately 109.5 billion. Based on this range, as well as the quarterly numbers and analyst estimates, I've calculated the following revenue projections. As my own projections are slightly more conservative, we'll rely on my projections going forward. Next, let's take a look at the net income and what we can expect based on revenue numbers. For net income, our projections range from 2.7 billion at the lowest profit margin of 2.6% to 6.9 billion at the highest margin of 6.6%. The average net income comes in at 3.9 billion, with our projections slightly higher at 4 billion. When you compare these two analyst estimates, we see that their numbers are slightly more conservative than ours. Therefore, we'll use their estimates going forward. We apply the same approach to EBIT and EBITDA. For EBIT, our projections range from 3.7 billion on the low end to 8.9 billion on the high end, with our estimate at 5.5 billion. For EBITDA, the range spans from 6.4 billion to 11.6 billion, with our estimate at 8.4 billion. While the analyst estimates are higher, our numbers are more conservative, so we will use our projections in the upcoming valuation calculations. Now, let's move to the final part of the analysis, where we calculate the stock value based on various valuation methods to determine what price we should pay. It's important to note that this is not a definitive answer, but rather a range of prices based on our assumptions. The numbers on the screen are the most important numbers used in these calculations. Please note that these figures are based on assumptions and this is not a financial advice. Thoroughly research any stocks before making any investment decision. We'll start with the enterprise value to revenue for 2026. For this valuation, we multiply the projected 2026 revenue by the multiple. This gives us a forward-looking estimate of the stock price if our assumptions hold true, which comes in at 163.80 By applying a margin of safety, the value reduces to $150.24. Next, we move to valuation 1 and valuation 2. We choose the same calculation with the only difference being the time span. The first is based on a 5-year period, while the second is based on a 3-year period. The perpetual growth valuation model takes into account EBIT, taxes and capex, and discounts this value back to today. In this case, it produces a negative number, indicating that Target is expecting to generate insufficient cash to cover its debt over the next 5 years. Essentially, this suggests that company has more debt than the current cash and cash flow is generated. This is not a red flag, but just something to keep in mind. For EBITDA, the calculation is similar to the enterprise value to revenue model, where the multiple is applied to EBITDA in 2030, and we discount it back to today, giving us a price of $123.73. The perpetual growth valuation for 3 years analysis again returns a negative number, which is expected due to the debt situation. EBITDA is slightly higher because of a higher EBITDA at that point in time. For unleveraged free cash flow, the first model considers EBIT, depreciation and amortization, capex, and changes in working capital, giving us a valuation of $56.99. The second model, which additionally includes interest and debt repayment, comes in at $58, and when we average these valuations, we arrive at a stock price estimate of $68.44, which is about 50% below the current stock price. We'll discuss this further later. Now let's compare these numbers with the industry average. For enterprise value to revenue, the industry average comes in at $132.66. Both valuation 1 and valuation 2 for perpetual growth yield the same result, as we are using the same input numbers. For EBITDA, due to different multiples, the industry average comes in at $163.60 for valuation 1 and $192.12 for valuation 2, with an average of $78, which is around $10 higher than the company's average over the last 5 years. Moving on to the analyst's free cash flow. We use analysts' projections for free cash flow over the next 5 years and over the next 3 years. For the 5-year projection, the valuation yields a price of $79.42, while the 3-year projection results in a price of $79.59. Next, we look at cash flow from operations, using two different calculations, one based on revenue and the other on net income. For the revenue-based calculation, we arrive at a stock price of $64.32, while the net income-based calculation gives us a $49.08. We also apply a free cash flow stock price multiple, where we multiply the average free cash flow from the last 5 years by a multiple of 20 to get an estimate of the stock price. No margin of safety is applied in this calculation, which results in a stock price of $167.19. When we average all of these results, we arrive at a stock price estimate of $97.47. The final valuation method is the terminal value, which is a revenue-based valuation model that considers 3 different cases. Based on this method, we calculate a stock price of $110.95. Now, if we average all these valuations, we arrive at a final price of $84.36. However, this isn't necessarily the price we will want to pay right away. We still need to assess whether this is a reasonable price, so let's start by looking at PE ratio. The trailing 12-month PE ratio for Target at this price is 8.94, while the forward PE is 9.80. To put this into perspective, let's examine where the company has traded in the past. Looking at the data going back to 2006, we can see that the lowest recorded PE was 8.11, which occurred just after the financial crisis in 2008. If we are buying Target at the price we are mentioned, we are essentially getting it at a very low multiple. The long-term average PE for Target is 16.71. This means that buying below this average could represent a good opportunity. So it's really a matter of how much you are willing to pay. If Target falls below 85, I see it as no-brainer purchase if the business remains as it is. For me personally, I would start considering adding it to my portfolio at around $100. At these levels, a PE of 10.59 still represents a relatively low price, and if I can pick it up for this price, I'll be very happy with the 9% return without dividends taken into consideration, if the assumptions made in the valuations are to be believed. Please also keep in mind that PE is based on the net income, so changing net income would also change the PE. If you believe that $100 is the right price to pay, but you are feeling impatient and want to buy it right now, the potential return from the stock price movement alone would be roughly around 2.5% going forward. When factoring in dividends, the total return increases to 5.8%. While this is below the market average, it is important to remember that we can't predict what the market will do in the future. There is no doubt the target has been beaten down recently, and with the stock at these levels, it offers a compelling opportunity. If you adjust just the EBIT and EBITDA to last 15 years average, then the average stock price jumps to $97.07. Just by slightly changing our assumptions, considering the highest numbers the company could achieve in the future, the stock price and overall investments opportunity change significantly. Let's quickly wrap up with dividends. Target current dividend yield is 3.2%, with a payout ratio of 49%. Based on our assumptions, the payout ratio is expected to remain stable, so there is no significant risk of a dividend cut. In fact, there is still room for dividend growth in the future. On top of that, Target has a solid share buyback program, which become especially valuable at lower stock prices. Over the past 5 years, they repurchased on average of 2.6% of their outstanding shares annually, further enhancing shareholder value. That wraps up our overview of Target. If you have any questions, feel free to drop them in the comments below. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more content like this. Thank you for watching, and I'll see you next time.